Hello, everybody. Good afternoon. I trust you're doing good. For some reason, a lot of our students are not online today, probably because of the holiday. I want to just give everyone an opportunity to make it to the class. So I'm going to wait for about 4 or 5 more minutes before we get into our class for today. So please don't get out of the call. Okay, welcome everybody. I think at this point we're ready to proceed. We have waited enough for anyone who was not in class, who had not yet joined us, that will join us along the way. All right, I trust you're excited to see me. I'm always excited to see you. If you're excited to be here, please drop a 1 in the chat box. If you can see me clearly and hear me clearly, drop a 2 in the chat box. So I'm expecting 1, 2, 1, 2 in the chat box. Let's go. Let me be sure that everybody can see me clearly and hear me clearly before we get on with today's class. Okay, Evangeline just put 12. Nice. Nice, everyone. Okay, Emeka, Mosu, Ata Michael, Namdi, Evangeline, happy to see one of you, Chinoye, Ebere on the call, Emeka is on the call. Yes, Victor is on the call, Ifan is on the call. Glad to see one of you right here. And we're going to move straight into it. All right, so one of the reasons, there is someone's microphone that is making noise. I'm going to mute everybody on the call right now. Okay, so I usually do not wait for any of us to join the call before we start our classes, but today's session is quite important because, like I announced last week, we are getting into another phase of our entire Forex learning sessions. And with this new phase we're stepping into, I do not want anybody to miss out. I want everybody to be carried along. It is one of the reasons why I want everybody to be on the call as at the time we're starting. And I mean, we used to be really prompt. I feel like we are slacking, so it's something to pay attention to. In our next class, we will not wait for anyone. We will start right on time. Worst case scenario, you watch your video a few minutes before the class time, and then we'll start our class right on time. Okay. So today we are going to be discussing something really important. Now, remember that so far we're still in we have had series of classes that have led up to this point, right? We have been laying more blocks on one another. We've been going from one step to the next, from one level to the next, from one grade to the next, and today we're about to build upon that and move on to the next level as well. So we started with market analysis. That was after we've gone into the history of Forex and all of that. We went to the background of money. We broke down all the basic terminologies. We talked about pips and spread and ticks and currencies, base currency, code currency, trading sessions. Every basic terminology that had to do with the Forex market, we were able to deal with them in detail. Right? Give me a minute. We're able to deal with them in detail. Okay. All right. So we took our time to ensure that all of that foundation was laid because we know that it is easy to just get confused when you're in an environment and strange terminologies are just being thrown at you. If you are going to learn a new field, the first thing you need to get familiar with are the registers, the markers, the terminologies that are used in that industry. And the terminologies that are used in medicine are quite different. Oh, wow. Someone says, he can't hear me. Let me be sure that this is fine. Second. Can anybody else hear me clearly, or is it just Victor? Can you hear me? Mosun says yes. I'm not sure if, Mosun, you can hear me clearly. So Victor, it's probably your audio device. Please check it. All right, thank you very much. Thank you for the feedback, guys. Yeah, I was saying that we had Victor tried logging out and logging back in. Perhaps you'll be able to fix something. We had laid some foundation and we started talking about market analysis. But before we went into market analysis, remember that we had dealt with two major parts. We had established that there were two major parts of. I'm sharing my screen already. I want to be able to share multiple screens so that we can move from charts to charts and all of that. Hang on a second. I want us to do some things in the chart. Look, you know how it is. Our classes always have to be practical, and I would only be able to do just a fraction of the explanation verbally. You will be able to make a lot of progress when we're able to show you what we're talking about, right? For me, I'm a very graphical person. I'm an eye person, and at every opportunity I get, I would rather show than tell. And also the way I learn is a lot by, seeing. I could watch videos and, really get the hang of stuff a lot faster than when I just, hear someone talk about it. I mean, hearing someone talk about this is one aspect, but when I begin to see what is being talked about, I absorb a lot faster. Okay, now today we'll be dealing with introduction to chart patterns. There are a lot of chart patterns. We're just going to deal with a few of them today, and we're just laying the foundation. Of course, while we're laying the foundation, we're going to dig just a little deep. We'll pinch a little into it, so you would have an understanding of what exactly we're talking about when we talk about chart patterns. Now, I was saying that there are two sides to market analysis, because the umbrella topic that we are dealing with right now is market analysis. And we have established that market analysis is divided into two parts. The first part is technical analysis, and the other part is fundamental analysis. And for technical analysis, we already established that this is the part that has to do with studying the charts and looking at what has happened in price in the past and using all of that data to make a forecast of what could possibly happen in the future. And of course, we know that past data is not 100% guarantee that something must happen in the future, but it just increases our chances, right? It makes our forecast a little bit more probable than it will just be. If we had no data to bank on or to look at, we'll probably just be guessing the forex market. If we're just coming to just say, is AUD USD going to buy today? Is AUD GBP USD going to sell today? And we just make a decision, buy or sell. That would be gambling, right? But because we have a lot of past data to study and analyze and look at and go through, we are able to now make an informed decision and make a forecast on what price could possibly do in the next few minutes, in the next hour, in the next day, in the next week, in the next month, right? Because we have past data to reflect upon, right? And then fundamental analysis, on the other hand, is another part of market analysis where we're looking at sentiments. We are looking at all the other factors that drive the markets. In this case, we're not exactly looking at the charts, right? We're looking at the presidents. We're looking at the politicians in that economy. We're looking at unemployment rate. We're looking at rate of consumption, rate of production, rate of, availability of social amenities, availability of infrastructure in those environments, and all of that stuff, right? And we're going to get deeply into fundamental analysis when we get to that point. Now, but for now, we are still on that technical analysis, and we are going deeper into it. We have been able to lay some foundation already, like you already know. Now, we already established that technical analysis, like I just said, is an analysis methodology for forecasting the direction of price through the study of past market data, primarily price and volume. And I've always emphasized over and again that the two most important factors that we consider when it comes to technical analysis is price and volume. Price and volume, those are the two most important factors that we consider when it comes to technical analysis. Okay, now a number of things that we will be looking at as well when it comes to technical analysis is price action, which is primarily where we study price and volume. And from that point on, price action leads to a number of other things. Chart patterns are there, candlestick patterns, indicators also plot graphs or visual representations of what is happening in the market that we can see, and we went through a bunch of indicators, just a few of them, the RSI, the MACD, the moving averages, and Bollinger Bands. And there are a lot more indicators. We're not closing that chapter completely, but the truth is, if we want to dwell on indicators alone, we will end up spending the entire period of the program just studying indicators, right? So we basically give you the four most important indicators that we feel you will need, and we're going to be able to roll with that while we move on. If along the way we feel the need to add other indicators for additional conference, why not? If not, we'll make that available to you. But for now, the information you have concerning indicators will suffice. And then trend line, of course, we've already dealt with that. So, I mean, it was part of the first things we dealt with when we got into technical analysis. Okay, so let us get right into it. So we dealt with indicators. I'm not going to define that anymore. You already know what that is. Now, chart patterns, right? Forget about what is on your screen for now. Let me take a minute to explain that to you. Let me just take a minute to explain chart patterns to you. Now, remember that I already established to us that Technical analysis basically has to do with the analysis of previous market behavior to make a forecast on what could possibly happen in the future, right? Now, what is a pattern basically? What is a pattern? Let me bring it to our layman explanation and use a layman terminology or a layman analogy. So, if, for example, you live somewhere, you live in FAB Estate in Guarimpa. I don't know if there is FAB Estate in Guarimpa, but I'm using that as a random example. So let us assume there is, you stay in the Federal Capital Territory in Abuja, and you are in the Guarimpa area, and there is an estate called FAB Estate at Guarimpa, and you stay there, and you realize that after your first week of moving in, every day by 12 midnight, electricity is seized. They seize power supply in that area. 12 midnight every day. Day one, you noticed it. Day two, you noticed it. Day three, you noticed it, right? A week passed, you noticed that 12 midnight every day, you would always cease to have power supply in your environment. What do you think would happen, right? The most logical thing that you would begin to do is plan your time around 12 midnight, right? And then you observe that they take it by 12 midnight and they bring it back by 6 a.m. in the morning. So 12 midnight, light is gone. 6 a.m. electricity is back. It happens day one, happens day two, happens week one, week two. You stay there for a month, it was the same, right? You realize that you have now noticed a pattern. You have noticed a series of repeated action that is almost predictable. Almost predictable 100%. I mean, we can never have 100% when it comes to probabilities because a number of factors are involved. But when you've seen something happen over and over again with so much precision, you can almost be sure that by 12 midnight in your estate, electricity is going to disappear, and by 6 a.m. electricity is going to return. And you'd be so confident to say it. Imagine I come visit you, I want to spend a weekend at your house, and you tell me, I'm going to charge your devices, so 12 midnight, lights gone, 6 a.m. is going to be back, right? You'll be able to tell me with confidence because you have seen it happen over and over again. Do you have any intel in the PHCN office that is telling you that, or AEDC office that is telling you we're going to seize electricity by 12 midnight? You don't, right? But all you have to bank on is basically data of the behavior of your electricity condition in that estate over a period of time. That is the same thing that we do in the market. So when we come to the charts, and we have a lot of behavior that has happened over time across different trading sessions, across different days, across different currency pairs, all of them have their different behavior. But there is a general market behavior that we can look at and say, hey, this pattern is fairly consistent, and we can expect that whenever we see this pattern in the market on the charts, which are always represented by candlesticks, whenever we see this pattern represented, we can expect this to happen, right? So when I see this candlestick form like this in this manner, I can expect that the next thing price is going to do is it is going to fall aggressively. Or conversely, when I see price arrange itself in this other fashion, I can expect that price is going to rise aggressively, right? So basically, based on the explanation that I just gave, we are only looking at previous price action or behavior to predict or analyze or forecast what could possibly happen in the future. Now, the chart patterns we are going to discuss. Now, when I talked about patterns, I was trying to tie that back to the market. So you should know that when I'm saying chart patterns, I'm basically talking about those things that we have seen happen in the market over and over and over again that are repetitive, right? We have seen certain behaviors repeat themselves in the market over and over again. We will see candlesticks forming in a certain way, and we will see that almost at every time, maybe about 80, 90, 95% of the time, when they form in that manner, something happens, right? So there are people who have sat down to, I've told you guys about backtesting, and someone would have gone back to check and probably analyzed days to weeks to months of price action, and has observed that anytime or almost any time that we see these chart patterns, in the market, we can expect certain behaviors. And that is what we're about to study in today's class. So all of that talk was just to give you a background to what chart patterns are. Now, there are a bunch of chart patterns, a lot of them, but we're not going to study all of them in today's class, right? So as I always do every time, I encourage you at every point in time to go and do your own research and check. We have given you the topic for this particular module and for this grade rather, and you are permitted to do your own research and learn. You can go ahead of the class if you want to, right? Go ahead and search on Google Forex chart patterns, and you would see a bunch of them. There are a lot of them. Forex chart patterns. You can go on YouTube and search Forex chart patterns, and you see a lot of explanations on all of them, and you realize that even after the 1 hour class, you'll be able to still draw value from a lot of other resources that have been made available on the internet. There is almost nothing that is hidden from you on the internet these days. So yeah. Let's get back to the charts. I'm going to share my screen again. Well, maybe not the charts entirely, but I want you to see my screen. Okay. Beautiful. So I believe you can see where we are, chart patterns. Now, there are a number of them, right? Now, chart patterns are basically divided into two categories. There are bullish chart patterns and there are bearish chart patterns. When I say bullish chart patterns, what I mean is that whenever you see those patterns and price was formerly bearish, you can expect that price is going to now reverse and become bullish, right? And for bearish chart patterns, if price was initially bullish, when you see the bearish chart pattern form, price would reverse and become, if price was bullish before, price would reverse and become bearish. That is basically what those things mean. And there are a number of them, right? But I mean, of course, there are candlestick patterns as well, the trend line and all that. But before we go into that, I want to always remind us of this, right? This is like the foundation for everything we are doing. The basic aspect of market structure is being able to identify what market is bullish and what market is bearish. And we already know that bullish market is characterized by higher highs and higher lows, right? So even if you are going to be looking at chart patterns, you should still be paying attention to what the overall structure of the market is, right? So it doesn't mean that when I say we can spot a bearish chart pattern that the entire market is going to start falling. A number of things come into play. For example, what time frame did you spot that chart pattern on, right? Were you looking at the 5-minute time frame, or were you looking at the daily chart? Were you looking at the 4-hour chart, right? I've told you that higher time frames carry more weight in terms of correctness than lower time frames. There is a lot of noise on lower time frames. You can see the market being bearish, heavily bearish on a lower time frame, whereas on a higher time frame, you just realize it's just a minor pullback and price is going to continue going back up, right? But if you are looking at the higher time frame, you'll be able to make a more informed decision. And we already know as well that the bearish market is characterized by lower highs and lower lows. If you do not understand this at this point, I recommend you to just Nicodemously meet me after the class and say, Joe, I do not understand what a bullish or bearish market is, and I will gladly take you back to square one of the Forex learning session of the Loomie CDE program. I mean, it's not a thing to be shy about. I'll just say, you know what, we have all the videos available. We'll make them available to you and put you somewhere that you can cook yourself to get back up to speed. But I believe everybody at this point already understands this. I mean, we've had assessments and everybody is on the same page. Okay, now remember this, that the financial market is fractal in nature. I keep saying this over and over again because it is so important. The market is fractal in nature. So it means that if on the higher time frame, price is bullish, when we go lower on the lower time frame, we should expect that what is happening on the lower time frame is going to feed into the higher time frame movement, right? So you would expect to see longer periods of bullishness as well on the lower time frame. Again, on the other hand, if on the higher time frame price is heavily bearish, when you go into lower time frames, the fractality of the financial market will make you still see that price is still going to maintain that directional bias, even though you're going to have movements of pullbacks and corrections and all of that, but the overall structure of the market is still going to remain the same, even though you are drilling down to lower time frames. So yeah, don't forget about the fractality of the market. It is so important. The financial market is fractal in nature. And what you are, another way to look at this is the same concept, the same principles that you are applying on the higher time frames can be applied on the lower time frames. So, and I'm saying this to even help you in the sense that when you go online, you go on YouTube and someone is trying to preach a strategy to you saying that, this strategy only works on the 15-minute time frame. Bro, forget it. The market is fractal. And if the market is going to respond to a certain set of rules on the 15-minute time frame, it will most likely respond to those same set of rules on a higher time frame or on a lower time frame. You understand what I'm saying? Right? So the market is fractal. It happens, it's like an onion bulb. You cut it, you see layers and layers and layers, but all of those cloves of each layer of the onion bulb will still have the same effect, right? When it gets into your eyes, you'll still tear up because they are still made of the same material. It's basically still onion. That was just a very layman example, but you really understand the concept of what I'm talking about, right? So enough talk, let us go into it. Now, there are a bunch of patterns, like I have said before, but the major patterns that we are going to be discussing today are let me see if I can write it out. The major pattern that I want us to discuss today is the double top and the double bottom. Double top and double bottom. These are the patterns we're going to be discussing today. Double top and double bottom. All right. So what does this basically mean? It is just like the name is. And this was one of the reasons why I decided to start with this, right? It is very straight to the point, just like the name is. Double top and double bottom. Now, but before we go into both of them, I want us to look at first into the double top and let us see the behavior of the double top. All right. Let us see the behavior of the double top before we now, begin to combine the two concepts together. All right. So when we see price moving in a certain way, let us not concern ourselves with time frame right now. Let us just pay attention to what price is doing. So price is basically making, higher highs and higher lows like this. And then we get to a point where we see something like this, right? I'm going to continue drawing, but remember, first of all, let us establish that we have a low, we have a higher high, a higher low, a higher high, a higher low, another higher high, a higher low, and price is here and has failed to break above this high. Price is at the same level of this high, right? Now, this can be a potential double top. A potential double top. And I say a potential double top because we can never be too certain of what price is doing until we have gotten additional confluences or confirmations. You understand what I'm saying? Most times we cannot tell 100% that, hey, this is what price is trying to do until we have seen additional confluences or additional confirmation. So what confluence could I be looking at? So when I see price doing stuff like this, what I want to do is observe. This is where we'll now go into candlestick patterns, right? And I'm not going to talk too much about that. I'm not going to talk about that at all because in this class, that is not what we're supposed to deal with. We're supposed to deal with candlestick patterns. Let's get into that. So if I come to the chart and I see the chart consistently making higher highs and higher lows, higher highs and higher lows, and it gets to this point and it makes a double top like this. So we have this peak 1 and then we have peak 2, right? One of the things I'll be looking at as additional confirmation is what kind of candles are forming here? If I look at it closely and I realize that I'm having a series of bearish candles, or I'm seeing bearish candlestick patterns, it is a confirmation to me that price is potentially trying to form a double top. And what usually happens when we have a double top, guys, is this. Let me show you somewhere else. When you have a double top, what price basically does is this. It will form, let me do this. It will form, sorry. This is what it does, right? It will form peak 1 and then form peak 2. This is a double top, what you have right here, a double top. So look at this, guys. Note that it is not always picture perfect. Your price movement is not always picture perfect. So the way I drew it, you would see that we almost have relatively equal highs. A lot of times you would have something like this, but there are times where this leg may be a little higher or a little lower than this previous leg. But all the same, it is the same chart pattern. Now, the double top is also called your M pattern because obviously it looks like the letter M. And on the other hand, your double bottom, which is something like this, where you see price forming relatively equal lows. You know, this is your bottom 1, and this is bottom 2, or first bottom and second bottom. And what letter does this look like, guys? Can you type it in the chat box? What letter does that look like? What letter does that look like? Anyone? W, exactly. So this is usually referred to as an M pattern, and this is usually referred to as the W pattern. And you can use these as confirmation on multiple time frames. And we'll go into the chart very shortly to look at it, right? Okay. Now, there is one more thing I want to draw your attention to before I get back to what I was explaining earlier. Now, when you have your M pattern forming, or when it has formed, there is something called the neckline. The neckline. The neckline. Please pay attention to these terminologies. There is something called the neckline. And the neckline is basically that point around this low. That point around this low. Right? It is a very significant point. So what a wise person who understands how the double top and double bottom works is, what he will do is this. When price has potentially formed this pattern, there are a lot of people who trade the M pattern or the double top in different ways. I'm going to just show you 2 ways that people trade the M pattern or double top. Method 1 is this. There are people who wait for the break of the neckline. They wait for a break of the neckline. And why do they wait for a break of the neckline? It is for one simple reason. Because remember that when we're dealing with market structure, we established that in a bullish trend, we are not expecting this leg to come and make a move that will take out this low. Do you remember? We are always making higher highs and higher lows. This low is not coming back to take out this low. It's not going below that low. We are not having a formation like this. Right? We're not having a formation like this. This is not what we are seeing in an uptrend. If I come to a chart and I see stuff like this, I would be like, what exactly is going on? I can't refer to this as a higher high and a higher low. This is obviously a higher high, but this is not really a higher low. So you can't just have your chart forming higher high and lower low at the same time. That is madness, right? If you see it happening in the chart, you may want to look closely at exactly what is happening. Now, there are different chart patterns. When we come to this aspect of the chart, you now realize that another pattern was actually forming, right? There are a bunch of triangle patterns, but actually, this is not a common triangle pattern. A more common triangle pattern is something else that we'll discuss, when we get to that point. Let me not confuse us with that now. Those ones have their own names, and that one we start talking about pennants and all of that, ascending triangle, descending triangle. Don't worry about it. We're going to get there very shortly. But let us focus on where we are at this point in time, right? So I was saying that we are not expecting price to take out this low, right? We're not expecting price to take out this low. So when price is doing this and is giving me huge signs of bearishness, what I'm having at the back of my mind is I'm expecting a retracement to at least somewhere, maybe in this area, right? A retracement to somewhere in that area. So if I was able to take an entry from up here and I've held price all the way to this area, what I can do is take partials and wait to see what price will do. If price breaks below this neckline, beautiful. I have had a sweet trade. I can expect price to keep moving in this direction, right? If price breaks below this neckline, I can expect price to keep moving in this direction and now start making, lower highs and lower low, because the double top is a strong bearish reversal pattern. The double top is a strong bearish reversal pattern, right? But of course, there are confirmations you have to look for, because another possibility that can happen in the market is that you can have price, and let me just give you another example. You can have price making higher highs like this, and then you have price do this and it's trying to pull back. So at this point, you would have come to the chart, you would have done your analysis as, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. But this did not form a higher high. This was a relatively equal high to this guy, right? Relatively equal high. So next thing you're watching is, okay, this has formed a relatively equal high and it's giving me signs of, bearishness, right? There is a chance that this might be forming an M pattern. So what would you be looking to do? You can flow when you have gotten your lower time frame candlestick, bearish candlestick confirmation. You can take an entry and move with price until you get to where the neckline. Remember, we call this place the neckline. This low, where if price breaks beyond, we can expect a reversal. That is called the neckline, right? You can expect whole price to come to neckline. So I was saying that sometimes one thing that can happen is price will get to this neckline and continue its movement upward. Next thing you are seeing now is we have somehow gotten to form a W pattern. First low, second low. Crazy, right? Remember this. Let me take you back just a little bit. Remember that we said that the market never moves in one direction in a straight line. Like the market never moves in a straight line. I mean, I can barely draw a straight line right here. The market never moves in a straight line. It always moves in waves. That is clear. But aside that, remember that we said that there are phases in the market. There are phases in the market. You could have your markup where price is basically making higher highs and higher lows. That is your markup. You can then have your consolidation where price is basically moving sideways, and then you can possibly have your markdown, right? So you another way for people who trade smart money concepts or institutional trading, you would have them say stuff like accumulation, manipulation, and distribution, AMD. Accumulation, manipulation, distribution, right? But what we're basically seeing are just the market phases coming into play, right? So you're having a period where the market was just bullish. Then you have another period where the market is moving sideways and it's just consolidating. Then you have another period where the market is bearish, right? So even if we were to have a bullish move, you will realize that you would have your accumulation, your expansion and distribution. Basically, I also talked about expansion and distribution the other time, right? So you will have your expansion, which is your market making higher highs, rapid higher highs and higher lows. Then you get to a point where the market looks like it has slowed down a little bit, right? It can possibly retrace, begin to make lower highs and lower lows, and then slow down a little bit again, and then continue making higher highs and higher lows to break this previous movement. So look, I hope you're not getting confused by all these plenty drawings I'm doing on the charts. What we are basically seeing is when you now look at it, see everything I've been drawing with single lines. you know that there are waves because the market doesn't give you a picture perfect scenario, right? It doesn't give you a picture perfect scenario. By the way, we are streaming on YouTube right now. So immediately after the class, you'll be able to have access to this particular session. Okay, so what you're having is your uptrend, your consolidation, and then your downtrend. Consolidation, uptrend, consolidation, downtrend. Now, there are times when these consolidations may not happen. You may have it for a very, very brief period. I mean, it can be so brief that it may look like it is absent, right? But basically, I just want to have this at the back of your mind. If you can understand the basics of the market structure and market cycle, it will really help you a long way, right? So let us leave all of this and get back to what we're trying to discuss today. And I believe that we are making progress. If you need me to slow down or pull back or step back on anything we have discussed so far, please drop a 6 in the chat box. Let me know. If you understand everything perfectly, drop a 7 in the chat box. Let us know where we are, and then we can move ahead. Oh, Ifeanyi just says, I just saw a comment that the audio is cracking. I'm so sorry. When I'm actually speaking, I'm not able to get feedback right away. Is the audio still cracking, Ifeanyi? Is anybody able to tell me? Is the audio clear now? Is the audio clear now? Anyone, come on. Oh, the audio has been clear. Thank you very much. Okay, let's go. Let's go. It's almost time for the class to be over. And this is the challenge I have when we start any class late. So remember what I was saying. We're discussing our double tops. Our double top. So we have the double top giving us this M pattern formation. And then I was trying to let you know how traders possibly take their entries and how they handle double top situations, right? Okay. So another way that traders handle the double top formation. Remember, all that stuff I was drawing was to make you see that the price doesn't just move in straight line. Like it doesn't just move the way I just drew it here. It always moves in waves. And so even this straight black line is basically a representation of the wave-ish movement of price, both to the up direction and to the downside, right? So all of these movements are happening in waves. So another way that people, let me not just say people, I'm talking about the Forex traders in particular who use this concept, right? Another way that they will trade something like this is, okay, let me just delete all of this, draw my M pattern again. So we have our M pattern, right? So price was going up, up. I want you to see this clearly. And then gave us that relatively equal high and began to give us signs of bearishness around here. We'll discuss all of these signs of bearishness when we start looking at candlestick formation. So I'm deliberately not talking about that or touching that right now. So price begins to give us signs of bearishness there. And we have seen that we have relatively equal highs right here. And this is our first leg and our second leg. And, we are seeing that, hey, there is a potential M pattern or double top formation that we're about to see here. So what do we do next? We identify our neckline, right? And we know that this is our neckline. So what the second set of retail traders would do is this. They would wait for price to break through this neckline and retest, right? If after the retest, they now have confirmations or signs of further bearishness after the retest, that is when they will take their entry. Do you understand what I'm saying? Right? So there are the first set of people who will take price all the way from the top here and follow it down here to the neckline and watch how price behaves from there before they either choose to exit the market or continue their position, right? And then we have another set of people who would wait for price to break this neckline and wait for a retest before they enter. So what usually happens is sometimes when price, breaks through the neckline like this, it will come back to retest, just like it does a lot with our support and resistance lines. They'll come back to retest, and then they can have their maybe candlestick formations that will give them confirmations of bearishness, and they will now look to go ahead and short the market. And I believe by now you already understand what I mean when I say short the market. It is not a strange concept to us, right? This is for the double top. Everything I've explained applies for the double bottom, except it is upside down. It is that simple. So I'm just going to take a minute to run through because our time is already well invested, right? So for the double bottom, what we're expected to see in the market is this. Price is moving like this, comes from a relatively equal low, and then begins to give us signs of bullishness. And then for those of us who are smart, we'll just realize that, hey, price has given us relatively equal lows here. This is our first leg. This is our second leg. We are beginning to see signs of bullishness right here. We're expecting price to begin to go up. And I'm drawing this probably as a representation of the three green candlesticks you see in rapid succession, or maybe you see one huge bullish engulfing candlestick, which gives you an indication of high buying pressure and all of that. And then you can look to follow price all the way from that point to where this place that we have identified as our neckline region, right? So what I can do is watch. So when price gets to this point, if price gets to the neckline and begins to do this, let me not draw that like that, right? Begins to give maybe weak rejections. That means there are a lot of confirmations. We'll get into that when we start going deeper. We just want to understand chart patterns first, right? When price begins to give us indications of bearishness from this point, we know that, hey, this neckline is quite a strong one. Remember as well that because we have already had an understanding of what our support and resistance lines are, we would see that the neckline region most times now functions as either a support or a resistance, depending on whether we're in a double top pattern or a double bottom pattern. In the double top pattern, like what we have here, your neckline region is acting as a support, right? It is acting as a support for price because price is above it. Remember, it is that region below price where we have seen price reject a number of times before. So this neckline region automatically, it doesn't even matter if we've seen 100 rejections before or we have only seen one rejection in the past. The fact that this is a neckline is usually an indicator or a pointer to the fact that there is a potential area of support in that region. So we'll be looking to see if that area is going to hold price up. But if we see price break through that neckline, we can expect price to continue falling to the downside. The same applies for the W pattern. This area right here potentially acts as a resistance. So when price comes here, many times it kind of tries to break through. You could have a reaction from that point initially, and then eventually maybe prices having enough momentum to break it, push to the upside, retest, and then go from here. So a bunch of people would wait for that breakout and then the retest before they enter from here and go on with price. I believe that is clear. If you understand that, please put a 4 in the chat box because we're about to go to the charts. So if you are, okay, I just recapped the neckline part and I believe that that fed directly into a various question. So if you understand that, please go to the 4. Type in the 4 in chat box, let me know we're together. 4. Okay, we all understand. I love that. I love that, guys. Okay, so I'm going to show you my chart right now. If you can see my chart, please put a 3 in chat box, drop a 3 in chat box. I'm going to spend just a few minutes on this and we are going to move on. If you can see my chart, drop a 3 in chat box. Please turn off your video, everyone. Okay. Let's go. I want to show you something. Oh, I'm seeing no charts. No charts. Let me share my screen again. All right. Can you see the chart now? Drop a 3 if you can see it. Drop a 3 in the chat box if you can see it. Okay, beautiful. Everyone can see the charts. Okay, this is nice. This is nice, right? Let us go and just try to spot 1 or 2 places. I just opened a random chart and I'm not even trying to be too picture perfect. Now, remember that I told you that all those things I drew, we will not expect them to be picture perfect, right? So there are times when you see a W pattern looking like this. It may not be exactly, an equal low like this. It may not be exactly like this. It could be like this. It could be like this. But ultimately, you will be able to spot the W pattern if you have trained your eyes well enough. And you can see it in multiple scenarios. Okay, so usually it even makes more sense if you see a W pattern forming in an area where you have additional confluence. All right, let's go. Now, let us look at the charts. And I just glanced through this chart very briefly. This is GBP USD on the 2-hour time frame. And I was able to immediately spot something that happened right here. So you would see we had this huge push to the downside. So we had, first of all, let us establish what is happening in the market. So what is the general directional bias? I mean, of price from this point to this point, right? So we had price from this point making higher highs, and higher lows, right? Again, I'm not trying to be too perfect. I just wanted to see the basic direction. Let us focus on just this region of price, okay? Just this region of price right here. We're not trying to look at the entire thing, so we don't get confused. Let's just focus on this region of price. All right, so we have established that the market is bullish because from the charts, we can clearly see that we're making higher highs and higher lows. And what did I notice? I basically noticed in this region, and this is just for practice purpose, right? I mean, we're backtesting, we're looking at price in hindsight. So look at what happened here. We have this high, this low, this high, this low, and this movement. What do you think that is forming from what you can see here? Obviously, we can see a form of our W pattern, right? You are seeing our W pattern forming. Now, let me see if I can go to the 30 minutes time frame and find that same area. Beautiful. Now, remember that I said price is fractal. I said that before, right? Now, this was our big W pattern that we had marked on the 2-hour time frame. Bear that in mind. Let us now look at what happened in this region. So I'm going to draw it again. And I'm seeing that on a smaller time frame, we are seeing other replications of the same pattern. So we had this very extended bearish move to the downside, this high, this low, and then this. What do you think this is forming? This is on the 30 minutes time frame. You can see clearly that this is also giving us a W pattern. See, look, I'm going to take us to advanced stuff where we'll start talking about smart money concepts, institutional trading, order flow, liquidity grab, manipulations in the market, and all of that. But I cannot begin to tell you about manipulations at this point if you don't even understand what is being manipulated, right? You need to understand the basic structure of the market, understand the basic retail concept. I want to show you we have time. I want to show you the retail basic concepts before I begin to take you deeper into the other stuff that you'll really find even more interesting. But this is even interesting enough, right? We just talked about it on the chart. We basically looked at it right now. We drew the patterns and all of that. And we can see something happened, right? So let me make this a bit thinner. Now, you realize that we have our neckline around this region. What did price do in that area? So price came down, came to this area, pushed back down. We have our relatively equal lows. Now, let us look at this on the line chart. On the line chart, you'll be able to even see this maybe a lot better. Okay, it's not as clear as I imagine it to be. Let me get back to the candlesticks, right? So again, this is our W. We came to this high, from this low, and then price, pushed to this point. This is in hindsight, but just trying to look at the chart based on what has happened in the past. But when we begin to do live trading sessions, we'll begin to reanalyze the market and see how we can get into the market while these patterns are forming. But let us look at what happened. What did price do? Price came to this region. Price came to this region, had some rejections. First of all, before pushing. You can even see this red candle, right? So it's possible that this neckline area was even a lot larger than I imagined, than I drew, right? You can see this red candle. So price even started pushing back down, but eventually was able to break through. We're able to break through, right? And you can see that, well, because this is on a lower time frame, we did not have an extended movement from that W pattern. But let's go back to the 2-hour time frame where we spotted that pattern in the first place. Where was it? I think it was somewhere here, right? Yep. We had it here. So we had our first leg, our push-up, second leg, and then look at this extended push-up after we finished forming the W pattern, right? As soon as we broke through that neckline region, which was here. Now, look at this. Remember, this feeds into what I was saying about higher time frames having more weight when it comes to confirmations than lower time frames, because the kind of reaction and behavior you will get in a lower time frame is not as effective or as magnanimous as you would see on a larger time frame. Look at this push. After we had a clear formation of the W pattern, we had an extended push to the upside. Push, it kept pushing up all the way to this region because it broke this neckline region. And then this neckline region ended up forming a support, because eventually when price, came back down, so price went up. When price came back down, you see these multiple weak rejections, rejection. Price held, that area held up as a support. And additional confirmation was we had that area being held up from here, right? And if you even go further down, you will see that area acting as a support right here. You go further down, you see that area, price sees long week here. Price came here, wasn't able to break through at first, went back up, and eventually had to come with a lot of momentum to break that, right? And we can see that still probably, okay, let's just leave it at this point, not to overcomplicate things, okay? But the W pattern is quite effective for those who are able to really spot it. Now, here is the tricky thing about the W pattern and the M pattern. I'm going to wrap up our class around here because we're basically almost done. Our time is almost over. Just like every other thing in the Forex market, your eyes will become trained to see all of these things with practice. When you have spent a number of, some good amount of time on the charts, soon enough, you will be able to spot these things without stress. Look at it here again, guys. Now, this one, because we're on the higher time frame, it is not so clear. So now, there are multiple things going on here I'm going to explain, and this will give you, let me just preempt you into our next class, right? So we have a chart pattern called the double bottom and the double top, which is what we just discussed in today's class. Now, there is another chart pattern called the triple bottom and the triple top, and we can see price forming the triple bottom right here, right? Our triple bottom is forming right here. And we can basically see our first leg, our second leg, and our third leg right here, triple bottom. But I'm going to deal with this in detail in our next class. For this class, let us focus on what we are talking about, which is the W pattern and M pattern. Now, because of time, I won't be able to overflow the issue like I would love to. I would ensure that in our next class, before we go a lot deeper, we'll do a recap of the double to the other chart patterns like the triple bottom and the triple top. But for this class, let me know if you have understood everything that was said. If you understand everything that has been taught so far, please drop a 5 in the chat box and I'll know we are on the same page. If I drop a 5 in the chat box, I want to know if the concept of the W pattern is clear to you. Okay, it is clear to you. I've seen 2, 3, 4, 5 people. Beautiful. So I mean that is quite clear to everybody. That is good. And if you need to refresh, go ahead, go to YouTube, watch this video. We are still putting our other videos together to put on YouTube because for like a week or two we're not able to do that right after every class. But this one's already streaming live. Okay, guys. So I'm going to call it a day right here. We're going to continue from here in our first learning session on Wednesday, and we'll be digging deeper, just a little deeper into the W and M patterns, and then laying a foundation for the rest of the patterns that we'll be discussing in our Forex learning program. I trust that you were able to learn a thing or two from today's session. Trust me, guys, I'm looking forward to the other things we're going to be doing, because the most important thing for us is to see you be able to go into the market for yourself and make trading decisions and become profitable, because that is where the meat is, right? But all of this foundation is necessary for where you are headed. So go ahead and be patient, go through the journey, go through the motions of everything we're trying to achieve. And I trust that you are going to be excellent and well-rounded on the other side, right? Now, the advantage, just one more thing before you get out of this class, right? The advantage of you getting to know all of these things is that we have a number of traders who just know a part of the market. They just understand one part. For some people, they only know about trend lines and they try to just trade based on trend lines. But for someone like you who has a number of options, you know about chart patterns, you're also studying about candlestick patterns, you know about trend line, you know about market structure, you know about the phases of the market, you know about fundamental analysis, technical analysis. By the time you are able to put all of this information together, you'd realize that you'll be able to make a more informed decision in the market compared to someone who did not have the kind of structured learning that you are being exposed to. All right, so I'm going to encourage you to go ahead and keep being involved in what we're doing, and by the time you begin to trade for yourselves, you realize that this is sweet. Okay, take care of yourself, guys. I'm going to see you guys tomorrow. We're going to be having a great time with Mr. OJ in our human capacity development session, and I'll see you guys again on Wednesday. For me, it's bye for now.